Question 7. Does the ETF consider future cash flow projections or solely rely on historical data? The Pacer U.S. Cash COWZ 100 ETF, COWZ, primarily relies on historical data, specifically TTM, trailing 12 months, free cash flow, for its selection and weighting methodology. Here's a breakdown. Focus on TTM free cash flow. COWZ uses a company's past year's free cash flow to calculate its FCFY. This metric reflects a company's past performance in generating cash. Why historical data? Reliable, verifiable. TTM free cash flow is a concrete financial metric based on past company filings and audited financial statements. This provides a reliable and verifiable data point for comparison across companies. Focus on proven cash generation. COWZ prioritizes companies with a track record of generating strong free cash flow. This historical performance suggests a higher likelihood of the company continuing to produce cash in the future, potentially leading to sustainable dividends or reinvestment for growth. Reduced complexity. Factoring in future cash flow projections adds complexity. Analysts' estimates can vary widely, and the accuracy of such projections is inherently uncertain. By relying on historical data, COWZ avoids the complexities and potential biases associated with future-oriented estimates. However, there's an indirect link to future expectations. Market capitalization. While not a direct future projection, the current market capitalization incorporates some element of future expectations. Investors, when valuing a company's stock, consider not just its current financial performance, but also its potential for future growth and cash flow generation. Limitations to consider. Past performance isn't a guarantee. Just because a company generated strong free cash flow in the past year doesn't guarantee it will continue to do so in the future. Market conditions, industry trends, and company-specific factors can all impact future cash flow generation. Limited insight into growth potential. Focusing solely on historical data might overlook companies with high growth prospects even if their current free cash flow isn't exceptional. Alternative approaches. Some investment strategies might incorporate analyst estimates or proprietary models to project future cash flows. However, these approaches are inherently less certain than relying on historical data. Overall, COWZ prioritizes the certainty and verifiability of historical data to identify companies with a proven track record of generating cash flow. This aligns with its objective of targeting cash-rich companies. However, it's important to understand the limitations of this approach and the potential for future performance to deviate from historical trends. Question 8. What is the portfolio turnover rate of COWZ ETF, and how does it impact potential tax implications? The COWZ ETF exhibits a high portfolio turnover rate. Here's a breakdown of the details and how it can impact your taxes. COWZ's turnover rate. Estimated at 90%, while official figures can vary slightly depending on the source, the portfolio turnover rate for COWZ is estimated to be around 90% as of April 2024. This signifies that, on average, the entire portfolio is replaced roughly every year. Tax implications of high turnover. Capital gains realization. With such frequent buying and selling activity, COWZ is likely to realize capital gains throughout the year. These realized gains are then distributed to shareholders in the form of capital gains distributions. Tax impact on shareholders. Depending on your tax bracket and how you hold COWZ, in a taxable account versus a tax-advantaged account like an IRA, these capital gains distributions can have tax consequences. Taxable account. If you hold COWZ in a taxable account, you will likely owe taxes on the capital gains distributions received. The specific tax rate will depend on the type of capital gain, short-term versus long-term, and your tax bracket. Short-term gains, held for less than 1 year, are generally taxed at your ordinary income tax rate, while long-term gains, held for more than 1 year, benefit from lower tax rates. Tax-advantaged account. If you hold COWZ in a tax-advantaged account like a traditional IRA or 401k, capital gains distributions generally grow tax-deferred within the account. You won't pay taxes until you withdraw the money in retirement, potentially at a lower tax rate. Additional considerations. Reduced after-tax returns. The high turnover rate associated with COWZ can lead to drag on returns due to trading expenses and potential tax liabilities from capital gains distributions. Investor tolerance for taxes. If you are tax sensitive and prioritize minimizing your tax bill, a high turnover ETF like COWZ might not be the ideal choice for your portfolio, especially in a taxable account. Here are some alternative strategies to consider. Lower turnover ETFs. Explore ETFs with lower portfolio turnover rates. These ETFs tend to hold on to their investments for a longer period, resulting in fewer capital gains distributions and potentially lower tax implications. Tax-advantaged accounts. Consider holding COWZ in a tax-advantaged account like an IRA to avoid current taxation on capital gains distributions. By understanding the portfolio turnover rate and its tax implications, you can make informed decisions about whether COWZ aligns with your investment goals and tax situation. Question 9. What are the potential risks associated with a passive investment strategy in a cash flow-focused ETF? While a passive investment strategy in a cash flow-focused ETF like COWZ offers potential benefits like diversification and convenience, there are also inherent risks to consider. Concentration risk. Sector bias. Due to its focus on free cash flow yield, COWZ might naturally gravitate towards cyclical sectors like energy or consumer discretionary. These sectors tend to generate higher free cash flow during economic booms, but can underperform during downturns. This can lead to higher volatility and potentially lower returns compared to a more broadly diversified ETF. Limited diversification within sectors. While the 2% weight cap per company prevents overall dominance by any single company, there could still be some concentration within specific sectors. For example, several energy companies with high FCFY could collectively represent a larger weight within the energy sector. Market risks. Market downturns. Even cash flow-rich companies can be impacted by economic slowdowns. If overall market sentiment sours, COWZ, along with other stock-based ETFs, could experience price declines. Rising interest rates. Rising interest rates can make bonds and other fixed-income investments more attractive relative to stocks. This could lead to investors pulling money out of stock ETFs, putting downward pressure on COWZ's price. Passive management risks. Limited portfolio control. With a passive strategy, COWZ tracks a predefined index. You don't have any control over the specific companies held within the ETF or their weightings. This might not be ideal if you have strong convictions about certain companies or sectors. Performance lag. Passive ETFs aim to match the performance of their underlying index, minus fees. If the chosen index underperforms the broader market, COWZ's returns will reflect that underperformance. Tax implications. High portfolio turnover. As discussed earlier, COWZ exhibits a high portfolio turnover rate. This can lead to frequent capital gains distributions, which can be a tax burden, especially if held in a taxable account. Other considerations. Focus on past performance. COWZ relies on historical free cash flow data. While valuable, past performance isn't a guarantee of future results. Companies with high historical cash flow might not maintain that level in the future. Limited growth potential. The focus on free cash flow yield might overlook companies with high growth prospects, but lower current cash generation. Mitigating these risks. Diversification. Consider using COWZ as part of a broader portfolio allocation strategy. Combine it with ETFs that focus on different investment styles or asset classes to reduce concentration risk and improve overall portfolio resilience. Tax-advantaged accounts. Holding COWZ in a tax-advantaged account like an IRA can help minimize the impact of capital gains distributions. Long-term investment horizon. A passive strategy like COWZ is typically suited for a long-term investment horizon. Short-term market fluctuations become less significant when you hold for the long term. By carefully considering these potential risks and how they align with your investment goals and risk tolerance, you can make an informed decision about whether a cash flow-focused ETF like COWZ is a suitable investment for you. Question 10. What is the expense ratio of COWZ ETF compared to similar ETFs? COWZ has a higher expense ratio compared to some similar ETFs. The expense ratio represents the annual fee charged by the ETF provider to cover management and operational costs. A lower expense ratio translates to a higher percentage of your investment return staying within the ETF. SPHQ 0. 15% has a significantly lower expense ratio. This ETF tracks the SP 500 Quality Index, which focuses on high-quality companies within the SP 500 based on factors like profitability, growth, and financial leverage. FNDX 0. 25% and PRF 0. 39% have moderately lower expense ratios than COWZ. These ETFs employ fundamental analysis to select companies, but their specific methodologies differ. RDVY 0. 50% has a similar expense ratio to COWZ. This ETF focuses on companies with a history of increasing dividends. Additional considerations. Investment strategy. The expense ratio should be considered alongside the investment strategy of the ETF. While COWZ might have a higher expense ratio, its focus on free cash flow yield might align better with your investment goals compared to other ETFs. Underlying holdings. Look beyond the expense ratio and compare the underlying holdings and performance of these ETFs. This can help you understand the potential risk-return profile of each option. Overall, COWZ falls within the typical expense ratio range for actively managed ETFs, around 0. 20% to 1. 0%. However, there are similar ETFs with lower expense ratios. The choice depends on your prioritization of expense ratio versus the specific investment strategy and holdings of each ETF. Question 11. Can a combination of other ETFs or individual stock picking replicate COWZ ETFs holdings more tax efficiently? Potentially, replicating COWZ's holdings with a combination of other ETFs or individual stock picking could be more tax efficient, but it comes with added complexity and management demands. Here's a breakdown of the pros and cons. Potential tax advantages of replication. Reduced turnover. By directly holding the underlying stocks or using ETFs with lower turnover rates, you can potentially reduce the capital gains distributions that can trigger tax liabilities, especially in a taxable account. Targeted exposure. You might be able to achieve similar exposure to COWZ's holdings by selecting a combination of sector-specific ETFs or individual stocks with high free cash flow yields. This could allow for more control over the specific companies you hold and potentially reduce unwanted sector biases. Challenges and considerations. Complexity: replicating COWZ's holdings requires significant research and ongoing monitoring. You'd need to identify the specific companies within COWZ, analyze their weightings, and potentially rebalance your portfolio periodically to maintain alignment. This can be time-consuming and requires a strong understanding of financial markets. Transaction costs: frequent buying and selling of individual stocks or even sector-specific ETFs can incur transaction costs, commissions, fees, that can eat into your returns. Imperfect replication: perfectly replicating COWZ's holdings and weightings might be difficult. You might not have access to all the same securities held by COWZ, and even with sector-specific ETFs, the exact company holdings might differ. Management time: this approach requires ongoing management and attention. You'll need to stay updated on the performance of the underlying holdings and potentially adjust your portfolio as needed. Tax implications of individual stocks: dividends from individual stocks are typically taxed at ordinary income tax rates, which can be higher than the capital gains tax rate for long-term holdings in ETFs, depending on your tax bracket. Alternatives to consider: lower turnover ETFs: explore ETFs with investment strategies similar to COWZ but with lower portfolio turnover rates. This can offer a balance between the convenience of an ETF and potentially lower tax implications. Tax-advantaged accounts: consider holding COWZ or similar ETFs in a tax-advantaged account like an IRA or 401k to avoid current taxation on capital gains distributions. That's all the moo-vellous knowledge we have for you today on the COWZ ETF. So, to recap, COWZ focuses on companies with high free cash flow, aiming for strong and potentially sustainable returns. But watch out for the potential downsides: concentration risk in certain sectors, tax implications due to high portfolio turnover, and a focus on past performance that might not guarantee future success. Do your research, consider your options, and don't be afraid to chat with a financial advisor. As always, leave a comment below and let us know what ETFs you'd like us to explore next. We love hearing from you.